Hi, everyone, and welcome to Eagle Investors. Today, we are going to be talking about equity. So, you've probably heard the term equity at Eagle Investors before. We talk about it quite a bit, but equity is a piece of a company. So, if you've ever heard about stock traders on the stock market and they trade shares back and forth, it's the exact same concept. Equity is just a piece of a company. So, if you have 5% of a company, that's equity. If you have 10% of a company, that's equity. Now, equity is what investors get in return for their money. So, an equity deal goes as follows. The investor gives the company money, let's say $100,000, and then they get 10% of the company in return. That leads straight into the valuation. Now, we talked about valuation previously, but we'll go over it right here. Valuation is how much the business is worth. So, to take the example we just did, if an investor gives a company $100,000 in exchange for 10% of the company, that means their valuation is $1 million. Pretty easy math. You just take the amount of money, you multiply it by the percentage of the company. So in this case, you would multiply it by 10 because you're buying 10% of the company, and you would get $1 million. Sorry. That's basically how equity deals work. Now we can divide the investment by the post-money valuation and multiply by 100 to determine the percentage of the company being purchased. So this is just this is just the formula. You don't need to memorize this. This is pretty easy. All it is a little equation you can use. Equity equals the investment plus the divided by the post-money valuation. If you watched the thing last week, it is the difference between pre-money and post-money valuation. Basically, post-money valuation is how much the business is worth after it's funded. So in this case, it would be a $250,000 investment divided by a $1 million post-money valuation times 100 would be 25%. You can just put that in a calculator. It's really easy to do. You can see here, this is on Shark Tank, like when a shark comes in and says, "Hi, sharks. Today I am seeking $200,000 in exchange for 20% of my company." That, again, would be a valuation of $1 million. Now, the sharks will often say that they want a different valuation, so if you hear them debate about the percentage or the amount of money that they're giving them, that's really just their way of talking about valuation. That's all they're saying. So at any time, if you're confused about what someone is saying the valuation is, you can just stop it, do the multiplication, and you can figure out exactly what they're saying. It's really easy. And a note here is the company is ultimately controlled by anyone who has 51% or more of the shares. So if you have any more than 50%, it's even like 50.001%, you technically control the company because you are the majority shareholder in that company. All right, types of equity funding. So seed funding is it's an investment by usually angel investors, and it's with a very, very, very early stage company. It's usually in the $1 to $5 million range of investment, as you can see here, and it's considered to be extremely high risk. So when we talk about angel investors, this is what they do. They do seed funding, so they find really small companies, they give them money, and they hope that they succeed. You might also hear about something called pre-seed funding, which isn't covered on the sheet, but basically what it is it's like seed funding, but even smaller. It's like $100,000 or so if someone really just needs to get their business started, and very small angel investors will give them pre-seed funding. Series A funding. So Series A funding this is where you get into venture capitalists. It's about $2 to $20 million, and they want a seat on what's called the board of directors. So board of directors is they're the people who tell the CEO what to do, and if a VC is going to invest in your company, they want to be a part of the people who run the company, obviously. Now, since we've gotten into series, we should talk about rounds of funding. Rounds of funding are really simple. They all follow the exact same the exact same pattern, and they're all lettered except for seed funding. But seed funding is basically just another type of funding round. So, Series A funding round, the way it works is an investor gives the company cash, the company gives the investor equity. That's the same way seed funding works. Now, the difference between Series A funding and Series B and C funding. It's the exact same thing, just with a difference in scale. It goes in alphabetical order, so you raise one round of funding, that's your Series A round. When you raise your next round of funding, that's called your Series B round. Your Series B round is almost always larger than your Series A round, and all that means is you need more money from more investors in order to keep growing the company. Then you can go to a Series C round, you can go to a Series D round, you can go to a Series E round. Some companies try to get clever with it to make it sound like they're not raising as much money as they are, I believe it's Facebook. They had like 3 Series C rounds in a row or something because they didn't want to say that they were going past Series C. But they ended up raising some insane number of rounds of funding before they actually got profitable. But in the end, it worked out for them. So that's rounds of funding. Let me know if you guys have any questions about that, but it's pretty simple. They're all the exact same thing. They just have different letters attached to them. Next is IPO, or initial public offering. An initial public offering is often how investors and the entrepreneurs themselves get their money out of the company. What this means is it's how you take it what's called public on the stock exchange. Now, if you ever wondered why you can, as a private citizen, you can buy, a share of Google or Apple or Amazon, but you can't buy a share of a privately held company like anything you see come through the Rice Business Plan competition, that's because it's not what's called a publicly traded company. An IPO is when a company goes from being privately held to being publicly traded. What this means is anyone in the world can get on the stock exchange and they can buy a share of Apple or Google if they want to. It's also called going public. The money raised in the IPO is used to pay back investors. IPOs, they usually give investors a very, very large return, and the same for entrepreneurs. So an IPO is one kind of exit you will hear about. Now, just to give you an example of an IPO, I think we've talked about this at some of the meetings, but a company that came through the Rice Business Plan competition a couple years called Hyliion, they did their IPO, I think, maybe a month ago, something like that. They went public and for billions of dollars, and their founder, who was a broke college student who showed up at the Rice Business Plan competition 5 years ago, is now the youngest billionaire in the United States. So, youngest self-made billionaire in the United States. So, IPOs, very good way to make money if you can take your company public. That's about all for today. Let me know if you have any questions and if you like this new format that we're trying, and I will see you guys at the meeting on Tuesday. Bye.